Dave, thank you so much for joining me on the Beyond Insurance podcast.
It's great to be here. Thanks for inviting me. And it's been a while since I spoke to the group, so glad to do so again.
Yeah, and Dave, we're super excited about this. It's a new year. I think a lot of people are ready to turn over that new leaf, and that's exactly what today's program is going to be about. It's going to be about how we got to where we are today and where we can see the industry going in the future and how can we best prepare. But before I dive into asking you to be a fortune teller and tell us where we're going, people who don't know who Dave Paul is or who Insurance Research is, can you give us a 2-minute overview of your background and your organization?
Yeah, sure. So Alirt Research specializes in analyzing the financial strength of insurance companies. In essence, we act as an outsourced due diligence team, and a hired gun, if you will, for insurance distributors. So kind of more precisely, you might think of us as a private rating agency and in an insurance research outfit. Outside of our core distributor clientele, we do work with insurers themselves, asset managers, premium finance companies, lenders, insurance buyers, including risk managers. So we do have quite a broad range of clients. My two partners and I have founded the company, have been in business or have been doing this type of work for 30 years, 20 years as Alirt. And we office together with our analytical team out of Hartford, Connecticut. So specifically, Alirt analyzes insurance companies across 3 models. We have a life model, a property casualty, and a medical healthcare model. We also look at offshore carriers out of the Bermuda and London markets. So I call ourselves a rating agency. What really honestly differentiates Alirt from the large public rating agencies is the application of what we call the Alirt Way, which you can see on our website. And really, it's an analytical philosophy based on three principles. One, we take a bottom-up approach to our analysis. So by that, I mean we focus on our analytical attention primarily on the insurer whose name's on the declarations page of the insurance policy, in which, as your agents will know, is the end insured that their clients have exposure to. This is opposed to rating agencies, which tend to take a top-down approach to analyzing companies. So we have a different perspective in that regard. Secondly, our work is ongoing, which means we feel it's important that we refresh our analyses on a quarterly basis. So we're doing stuff kind of in real time for folks so they can get a real sense for how their companies are performing over time. And thirdly, our analytics are comparative and measurables. We have an Alirt scoring system versus ratings, if you will. So that's kind of what differentiates us in the market, if you will.
I love it. And that is exactly why we asked for you to join us today on these market predictions and market history, course, so to speak. So before we get into where we're headed in 2021, it would be great if you could take us back over the past decade or so in the property casualty market. How did we get to where we are today?
That's a good question. So outside of our what I'll call our micro analysis of thousands of insurance companies every quarter, we also publish quarterly macro reviews of our sectors, the PC, life, and health sectors. And this provides our clients with kind of a big picture to frame, kind of to understand the individual company performances that we also provide, obviously. So as regards kind of the macro financial performance over the last decade, I'll concentrate kind of on 3 specific areas that we focus on when we give these types of talks. And that would be the industry capitalization, premium growth, and then, of course, the underwriting and operating profitability of the industry. So starting with surplus, just to give, and surplus, of course, is a difference between assets and liabilities. It's the equivalent of capital. That's sometimes called capital when you're studying finance in college, if you will. It's the cushion that allows these companies to essentially be able to make up for any problems they have, whether it's on the asset or liability side of the balance sheet. So it's very important as credit analysts to constantly monitor surplus. So over the last decade that you asked about, the industry surplus, and when I say industry, I'm talking about the US-based property casualty industry. Surplus has grown from $550 billion at year-end 2010 to 870 billion or around there as of 9 months of last year, the latest information we have. So that's about a 60% gain over the last decade. That's really good, right? We like that. In comparison, we always compare this to net premium growth. Net premiums have grown about the same percentage, from 425 billion to around 660 billion. And by comparing those two metrics, we come up with an important metric, which we call the net premium leverage, or the ratio of net premiums to surplus. And this is important because that really is an expression of the capacity of the industry to write business. And we can talk a little bit more about that later if you want. But the end result is, in terms of its capitalization, the industry is really extremely well capitalized. Surplus continues to grow every year, which again kind of makes the current pricing cycle a bit of an anomaly, right? And I know that we'll probably touch on that later. Turning to premium growth, the second item. As mentioned, we've seen good growth over the past decade. It's kept pace in terms of its percentage growth with what we've seen out of capital or surplus. But the fact is, because the industry is so well capitalized, the industry really can write more business on that surplus base. So without compromising, the financial viability of the industry. So this is very important. So traditionally, just to give a sense, rating agencies and regulators have allowed insurers, as a general rule, kind of looking across the whole industry, to write premiums of up to 2 to 3 times their surplus base. Well, if you do the math quickly, currently the broad US PC industry is really writing at under 1 times its surplus, around 0.8 times its surplus. Or put another way, there's more than $1 for every of surplus for every dollar of premium written. This means there's a lot of capacity in the U.S. market, right? But we always like to point out, just because the industry can write more business doesn't mean that it will, right? And this is partially because the business supply simply doesn't exist. There's just a lot more capital in the industry than there is business to write against it. So obviously, if we could open new lines of business, certainly if the economy would come back, that would be great, because that would bump up exposure units, et cetera. So we're really looking, we're really trying to express that there is room for more growth if insurers want to take it. But insurers, of course, aren't going to take business where they don't think they're going to meet their profitability hurdles. And this is what we're seeing in the industry right now. They're simply walking away from business, if they feel that they can't get the right price. So that's going to be something, obviously, that the agency community is going to continue to have to kind of fight against, if you will. But at the end of the day, the industry, again, is well capitalized and has a balance sheet to write a lot more business should it want to. Now, lastly,
before you go in, so I want to summarize just to make sure that I'm listening to you correctly. So number one was that there's a lot of capital in the industry that can be moved around to help support any, the whole industry in and of itself. And then number two is there's a lot of capacity for agents and brokers to write more business, but the challenge is the business just isn't there. So it's almost like having a really large bucket that's half full. Is that correct?
That's a great, Matt, that's a great way to put it. The surplus bucket is very big, and it's about maybe, I don't know, three quarters full of what it probably could be, or even half full, if you will. But again, there's constraints around, is the business there to write? And if the business is there to write, do the insurers want to write it right now?
It's so interesting that you say that, because when I speak with agents, daily, one of the number one issues that agents have today, I feel, is prospecting, not able to fill their pipeline with enough accounts. My perception was that it was just because it's the hardening market, especially, COVID, it puts a whole nother realm on whether insureds actually even want to move because of risk and uncertainty. But what you're saying is that there is capacity for people to write the business, but the business just doesn't even exist in the first place. So, as you said, so boom, improving our economy, getting more of those businesses out there, allowing small businesses to grow to larger businesses, getting no businesses to turn into businesses, is really the magic to helping ease some of these tensions when it comes to prospecting as well. Am I kind of giving a good projection in this chain? Maybe I'm just hypothesizing a little bit.
No, you're absolutely right. I guess, again, at the end of the day, if there's more exposure units out there to write, there's capital right now in the industry to write it. if it's at the
Awesome.
right price, right? Because these
Excellent.
insurers
Yep.
are not going to write business and lose money.
Yep. No, that,
No
that
one
makes
wants to do
sense.
that.
All right. So jump in. You said you have a third. There's a
Yeah,
third
so the
pillar,
third,
right?
obviously, and maybe most important or very important is obviously the underwriting performance of the industry, what we just talked about. So on a broad basis, and this is very interesting, looking at the whole US property casualty market, which we do quarter after quarter, the industry has generated an underwriting gain in 9 of the past 17 years, okay, including through 9 months of 2020. We don't have the full year stuff yet, which is really astounding considering what we went through last year. So
Yeah.
this is especially interesting because if you, from 2004, if you go back 30 years, the industry did not make 1 year of underwriting gain, right? So, and the reason for that, quite honestly, and we'll talk about this in a second, is the investment environment in terms of net investment income, really for the last decade that you've asked me about, has been historically low. So basically, the insurers have not been able to underwrite at a loss, but make up for that income through investments, right? So investments are down. So that's kind of why we're seeing this discipline in the industry, which I'm sure your folks have read about. But as concerns to operating earnings, which is, again, the sum of the underwriting results plus the investment income, they've really been decent at about a 10% return on earned premium over the last decade. So really, you'd have to go all the way back 20 years to 2001 to see the last period where the industry actually had an operating loss. So to sum up, I would say the industry is well capitalized, which we talked about, and it continues to make decent underwriting and operating gains, right? And so all this taken together creates kind of a strange environment, right? This is an industry historically, it's historically strong on kind of all the fronts I've talked about, but rates are still firming and rising, right? And this is why this cycle has been called kind of an underwriting driven hard market, which if you want, we can kind of talk about later. But those are the kind of the three basic areas I think that people, if they focus on, they get a good sense of what's going on with the industry.
Very, very interesting. And so when you're talking about like an underwriter driven one, if I had to guess how we're pulling this together based off of what you said, and let me know if my thought process is correct, because the underwriters have not made enough investments and they have been very flexible with their pricing, they now need to make all that money up. So they're essentially catching up. Is that to make sure they are also profitable? Is that sort of my understanding of where this is going?
So yes, they're. I don't know that I want to necessarily say they're catching up, but basically, and we could talk about this a little bit later. But through our analysis, the industry is losing on average over the last, let's say, 5-6 years, about 3 points on their operating ratio, which is an expression of the ultimate operating profit, and that equates to about $20 billion of monies that would traditionally be investment income monies that is just not there anymore compared to average. So that money has to be made up somewhere, and the insurer managements are aware of it, and they obviously now have to look to underwriting to make up for that. They can't run the losses and hope to make up that $20 billion, if you will.
Got it. Okay. So thank you for the historical perspective. I think that's really a good baseline to begin discussing 2021. At the time of this recording, I think we're like 10 days into the new year. For some, they thought, hey, this COVID's going to be done by 2021. It's obviously not. We're still trying to navigate the best practices with coming out of this pandemic effectively, both personally and professionally. On top of that, we all are aware that there is a hardening market as well. But I think we all really want a reset. So with that in mind, there's a lot of things that came onto all of our radars in 2020, like catastrophic losses, difficulties in some casualty lines because of social inflation. Obviously, the one that everyone has been talking about for the past 11 months, COVID, and the low interest rate environment. So how is that going to impact our industry going forward?
Yeah, I mean, listen, you've correctly hit on the big four there. Obviously larger than average weather-related losses in 2020, but quite honestly, over three of the last 4 years on the charts that we keep, the rise of social inflation, certainly COVID, losses in the interest rate environment. So we'll take them in order. As concerned cat losses, there's really no way to predict, looking into 2021, what's going to happen to the weather in any one year. It's really not that long ago. If you look back to like 2013 through 2016, that we really had a period of a nice stretch of below average cat losses. So, it cuts both ways, but that said, there's a lot of analysts pointing out that a growing trend of larger weather-related losses, whether that's due to purported climate change or to the growth of exposure units in coastal and other cat impacted areas such as California, parts of the Midwest potentially. So, these types of concerns about changes in weather patterns have certainly led to sharp increases in, I won't say in all property rates, but certainly in some areas on both the primary and reinsured basis. And the reinsurance is important, obviously, because reinsurance pricing drives primary pricing. But, as the insurers and reinsurers really start to question the accuracy of their models, especially given, the large hurricane losses, a large convective storm and wildfire losses, et cetera, over the last 5 years or so, I think their reflex is really to just ask for more money, right, to cover the known unknown. So in short, we saw at the 1/1 renewals for reinsurance that they were orderly, they were less costly to the primary insurers than had initially been thought. But, certainly the reinsurers are keeping a very close eye because they're the ones who took some of the real big, heavy losses over the last 4 years in the big cat years. So that's it's hard to predict, but my guess is that property rates are just going to be taken because, they don't know and they want to, and I think in a way, to what you said before, they are trying to backfill for some of these losses, right, that they took in the last several years. So, social inflation, I would say the second point, is much less of a wild card. It exists. It's clearly documented. You can look at the number of lawsuits being filed. You can look at the average size of settlements in the casualty lines that this is impacting. So that would be frequency and severity is up. And so given this, we've seen a retrenchment looking at the individual companies and the lines of business by a number of insurers really who have experienced sizable losses. And we've seen the growth of this business going to the surplus lines market, which we tend to see when the admitted markets get involved with lines of business that they end up kind of getting killed on, right? So we expect this trend certainly is going to continue. We're going to see higher rates for the impacted lines. Generally, it will be your excess and general liability exposure, some of the professional liability lines, et cetera, that are essentially exposed to social inflation trends. And we're just going to watch to see how that develops. Turning to COVID, the third point, COVID, the losses have not been as large as originally suspected, both globally and in the US.
Wow.
And, one of the fears obviously up front was that, we're going to have these massive business interruption lawsuits. I mean, the US has been able to do a good job in the US kind of, in the courts defending themselves against these. So they really have not come through. The global insurers, and so this is globally now, that have reported $30 billion of insured losses. I'm just kind of taking a look at this. So, it's 30 billion is a big number, but again, it's not all in the US, that's globally. But the ultimate estimates are all over the place. The ultimate estimates are anywhere from 30 billion to 100 billion. Lloyd's is still sticking by there's going to be 100 billion of insured losses. To me, as an analyst, honestly, it's hard to see how we get to that latter number at this point. And quite honestly, if those losses come through or whatever losses continue to come through, I think they're really going to hit the international reinsurance community more than kind of the insurers that your agents kind of play with. So, there's going to be knock-on impacts, I'm sure, on workers' comp losses and certainly rates potentially going forward reflecting, some of the states have these rebuttable presumptions in place. And, there'll be additional losses tied to things like event cancellation, et cetera. But all in all, I think that we are in a good spot in terms of what we're seeing for COVID losses now. That we track every quarter the reported losses from insurance community. And since the second quarter, they've really, every quarter they've slowed down. So we expect that that may continue to be the trend. So we're not super concerned about COVID at this point as analysts of the US PC industry. I mean, some more will come through in 2021, but it shouldn't really move the dial too much in our view as of now, right?
Mm-hmm.
The last factor, quickly, interest rates. You know, I said before, they've been historically low over the last decade. They've definitely contributed to the underwriting discipline, kind of putting a floor under rates. And so, you know, so what are we seeing? You know, interest rates have moved higher, as you know, over the last, you know, really only almost a month. In anticipation of the new Biden administration, you're going to get much more aggressive fiscal programs. You're going to get a hope for a rebound in economic activity with, you know, as the pandemic either greatly moderates or hopefully ends by a certain point. And higher interest rates, really, all things equal, should follow if the economy picks up, and that should hopefully help to blunt the demand for additional premium rate increases.
Mm-hmm. And so, as I'm listening to you, one of the things that I was recently on a webinar with Beyond Insurance CEO Scott Addis, and he was talking about what he did during his time at the Addis Group during the last hard market to weather the storm with his clients. Because while many agents, if they're paying attention to the industry, probably have a lot of education or at least aware of what's happening in terms of rate increases, sometimes that, you know, the average consumer is not, they're not spending their time understanding the insurance industry. So one thing that they did, and this is, I'm going to tee you up for this next question here, is send a note to all of their clients at the Addis Group at the time and give them a full picture of exactly what's going on. And what I love about what you've told us so far in terms of where it is, where the industry has been, that can go into, if you're to craft, you know, if you're an agent listening today or an agency leader, if you're to craft a letter or a message that is going to your consumers to prepare them for this hardening market, you can not only now give them insights into where the industry has been and how we've gotten to where we are today, but also reassure a lot of your consumers on some of the things that may have raised concern for them, right? Like cat losses or COVID or social inflation, and how that's going to be impacting the industry moving forward. So the final piece to crafting this story or this communication to your insureds would be rate scenarios. So are you able to give the listeners here today some different rate scenarios for personal and commercial lines for the insurers, and expand on where these rates may be heading for 2021? Because I think that if between history, last year, and now you're going to be able to give us some insights into perhaps what we can expect in 2021, this is a picture perfect message that should be packaged and sent to any client to prepare them. So
yeah, no, it's so listen, I mean, you know, obviously we talked about some of the broader factors that are impacting the whole industry. When you break out personal lines and commercial lines, the rating cycle for personal lines has always been much less pronounced than commercial lines. Upfront, clear. Why? Because honestly, the underlying underwriting results for homeowners and personal auto business, which are two of the largest lines in the US PC industry, they're generally very, very predictable, right? Than those, honestly, for certain commercial lines of business. So right away, we're not going to see, and traditionally have not seen, any real wide swing in the rate scenario for personal lines business. So that's very important. If I were to guess, and again, these are guesses, but based on what we look at in terms of, and we look at a bunch of the different, the brokerage and different kind of rate surveys that come into us, I guess that personal auto rates will stay fairly flat. And this is especially given some of the large, obviously, COVID-related gains in the line in 2020, right? People not driving, et cetera, et cetera. And I know that there were give backs, but even with that, you know, I think that there's really no reason for rates to be moving up there. Homeowner rates, I think, will also hold fairly steady, with a caveat outside of areas impacted by a surge in cat losses over the last several years. So if you think Florida is a very difficult market. It's a really dysfunctional market. We follow all the carriers there, and it's a constant struggle there, right? Other southeastern coastal communities, we saw Alabama get hit, you see Louisiana get hit, all those types of areas, fire exposed communities in California. We have to accept those, right?
Yep.
But generally overall, that's what we see will likely happen in the two broad personal lines. Commercial lines is a little bit of a different story. It's a story of different markets, if you will. I think that workers' comp, which is obviously one of the second largest line in the commercial side, will continue to be flat or even slightly down. This is now a multi-year trend. Turning to commercial property risks, again, this is where we're starting to see the real higher pricing come in. And again, this comes from broad market surveys. It's not going to be everywhere in the U.S., but we are seeing higher pricing there, and sometimes shockingly higher prices depending on where the risk is and what their experience has been. The impact on liability lines is also going to be really determined by the sector, and it's going to be industry specific. My guess is that the general and excess liability lines will remain open to further increases. And certainly some of the professional lines, liability lines, D&O in particular has been hit very hard, and we're seeing some real extreme moves in cases from the broker surveys. I'd say the last two lines, which are quite large in commercial side, they'd be commercial auto, medical, med mal. Both remain very problematic from our perspective as analysts. And I would be very surprised if really aggressive rate actions moderated from here. I think you're going to see some more rate coming through, certainly in those two lines of business as well.
Mm-hmm. Absolutely. And again, you're giving us so much data, and knowledge is power. Of course, we know that. And so every agent should have an understanding or be excited about learning more about this industry and all the factors that play into what makes this industry so great and where it's going tomorrow. With that in mind, how can agents gain a competitive advantage by becoming more familiar with the financial basics of our industry? Do you have any suggestions for someone listening today?
I do. They're a little biased, but I think the best way to answer this, quite honestly, is really just to give examples of the types of calls we get here at Alirt from folks like yours in the agent community. Mm-hmm. Here's a recent example. I got a call last week from the head of sales from a really relatively small agency. He had heard me give a presentation like this on the state of the industry, and really he had 4 concerns. And thinking about this, so he basically says, hey, he genuinely cares about his insured clients. He wants to make sure that when they're out negotiating on their behalf, they're getting the best price possible. But he, in this environment especially, and you mentioned this before, Matt, he has a sense, and insurers are to agree, just throwing out numbers, right, and not looking specific or not underwriting specific to each individual case. So he tries to keep up on the state of the insurance industry. And what he's found is that, looking at the trade magazines, the kind of the blurbs he gets from these articles, they're really just not sufficient. So, and he said he's looking at the big broker, year-end releases on what the market's doing, but he worries that their observations are really for a higher end market than he's working in. So he's basically saying, hey, I'm just looking for good ongoing industry analytics, kind of like what we're talking about today, that are digestible, to your point, that can be kind of put in front of clients to make him a better advocate for his clients overall. Again, to make them understand the context of the environment, okay? Secondly, what he said, hey, 85% of my business is with, what we call kind of the big 6 or the big 7 large national insurance groups, the Chubbs, the CNAs, right? The Hartfords, Liberties, Travelers, Zurich, et cetera. And, maybe a handful of regional. So this is very typical of what we see with our smaller and middle market agencies. But then you have this 15% niche of carriers that he worries about, whether it's due to that they're lower rated or that there is some in a niche focus in certain more problematic kind of specialty lines of business. So he really wants to get his arms around that kind of 15% that he just doesn't know about and is uncomfortable about, et cetera. Thirdly, he says his other concern is he's out competing against insurers that seemingly are out just buying the business. He might not kind of know who they are. They're smaller insurers. How can he demonstrate to his clients that, that these insurers, they may be 20, 30% cheaper, but they may be facing substantial financial stress that doesn't really come through just an AM Best rating alone. And he wants to steer them away from a potential kind of penny wise, pound foolish decision. And by the way, maybe keep his, BOR, right? So but and maybe his last consideration is just, we see this more with our larger broker clients, honestly, but just this desire to professionalize the oversight of all their insurance carriers. So to do more than just spreadsheet ratings, to understand companies that are getting into financial trouble before they kind of hit the skids and they're downgraded, because this can cost them lawsuits, and they just want to kind of stay away from that. So, those are 4 ideas or kind of things that are in the minds of an actual agency guy who just called me, and we get those types of questions all the time.
Mm-hmm. And a follow-up question to that: how can an agent use this type of data to better serve their clients? So, for example, I suggested a client letter, taking these types of insights, pulling it together, and proactively alerting their insured of what's to come in 2021. But what other suggestions might you have? How can an agent listening today take everything that you're talking about, perhaps do additional research using, services like yours to better help the people that they're trying to serve?
I think you've hit on it already. Listen, we know it's precisely in a hard market, right, that agents are going to be faced with difficult discussions,
Mm-hmm.
right? Their clients are facing substantial price increases. Those are hard discussions. And some of your agents probably have never been in an environment where they've had to face those types of discussions. So I think, as you said, if you're able to put some historical perspective around the pricing cycle, kind of, hey, you remember all those times when your annual renewal was flat to down? Well, to understand the dynamics that impact the entire industry, the things we talked about, cat losses, social inflation, COVID, reinsurance pricing, interest rates, the ability to talk in broad strokes about the industry. I think it does 2 things. It gives your client, importantly, a sense that he or she is not being singled out, right?
Mm-hmm.
That this is an industry-wide phenomenon. Calms them down that regard. I think as important, your knowledge around the topic will differentiate you from 99% of your peers. Because honestly, what we see is people going in saying, oh, it's the AM Best rating is XYZ, and that's the end of the discussion about carrier or industry or whatever. So I think having some of this in this background, it shows a client that you're a student of the industry, that you're professionally informed, risk advisor, you're not just another quote unquote insurance salesman. And, I think that would help to sustain these relationships. I think it would certainly give you an edge in a prospecting situation. So that's certainly one thing. The other thing, again, talking about a hard market that we're in, there's a tendency for more business to be shopped.
Mm-hmm.
And that's just, you guys know it even better than I do. When those prices come in, the insured saying, hey, you got to do better, or, we've got to look around. So, I think that you're probably better able to defend your existing business via either well thought out alternatives or to be able to better compete for the new business. If you know the financial dynamics of the insurers that you have kind of in your hip pocket, and those that you may be competing against, and what's going on in the market, you're going to have a lot. I imagine you're going to have a lot more at bats, or certainly, you're going to be having these types of discussions a lot more than maybe in a non-hard market environment.
Mm-hmm. And I love that you say that, Dave. I mean, that Beyond Insurance, the whole foundation of what Scott did to build his agency, what we do every day with agents and brokers, is help them understand that we can take price off the table by educating the customer on things that they didn't know. And I think up until very recently, that type of knowledge came through with products, services, risk management recommendations, expertise, either through risk vertical or in industry expertise. But this is a whole new opportunity, is to position yourself as an expert on the hardening market, why we got here, where we plan on going, so that when these accounts, like you said, are going to be shopped because they feel like they're going to be able to get a more competitive opportunity, you're not only going to be able to provide them that competitive opportunity, but you're going to be able to provide education as well. And that's what we're finding most consumers are appreciating with these new risk consultants. I like to wrap this session up. You've given us a ton of insights, a ton of details, a ton of data. But someone listening today, if there is one thing that they can start doing tomorrow to begin to take action on everything that you shared today, and it was extremely enlightening, what would be that one recommendation you have that you can provide that professional that's listening?
We've touched on already. I'd say that the one thing is get educated on the basic financial underpinnings of it's your industry, right? And by that, I mean both on a macro basis, so kind of the things we've talked about, the broad financial brush or broad financial health of the industry, as well as kind of understanding some basic information, what I'll call the micro basis. How are your individual partners faring financially? So maybe at a minimum, understand the mechanics of a combined ratio. What does a combined ratio mean? Understand how industry surplus reflects the capacity to write business. What kind of factors drive the rating cycle? These things that we've talked about, especially as regards things like catastrophes and interest rates, right? I'm not saying that someone needs to be a seasoned credit analyst. Listen, I've done this for 30 years. I don't expect you to be me, nor do I expect myself to be an agent, on the front lines. But I think that you can really start to learn the broad themes, how they impact the pricing environment, and the price of insurance that you're placing in front of a client or prospect. So, I think this type of knowledge, especially in 2021, is going to make you a better advocate for both the end insured and your insurance partners by allowing you to better separate what this gentleman on the call the other day said the bluster from what's really going on out there. And, negotiating a price that's ultimately fair to both parties. And I think that's the best way to kind of approach that theme.
Awesome. Well, Dave, again, you've given us so much of your time, your research, your data, and a lot of really practical solutions that I think those that are listening today should definitely seriously consider. How can you take all of the knowledge that was just shared on today's program and use it to better educate your clients, prospects, and community on what's to come in this amazing industry? So I want to thank you for your time today. Dave, if someone wants to learn more about you and your team, what is the best way for them to do so?
Well, I know you guys well. They obviously can come through you and Scott to get to us. Obviously, we have a website, alertresearch.com. If someone's interested, I'm at david.paul, and those are both two first names, at alertresearch.com. Alert is spelled ALIRT, research. Or if someone wants to call, we're at 860-683-2070. So yeah, anyone who wants to chat, even if just, we're always happy to talk to anyone. So we always say as analysts, we get as much out of these calls as you do, because you guys have some important frontline information that we're not always privy to. So, look forward to hearing from anyone who wants to reach out.
Awesome. Well, again, David, thank you so much for joining me today.
Matt, thank you for having me, and best of all, Happy New Year.
You too. Have a great day.
All right, you too. Thanks.